Hey, this is Mark with Rightline. Almost starting in about 60 seconds. Traders are still coming into the room. Hey, good afternoon, everyone. Nice to see everybody. Just going to start with, unfortunately, with this disclaimer that that Rightline Trading takes no responsibility for any participation by visitors or subscribers within futures or forex markets, or for any profits or losses that may be incurred. Careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account on any trade. Do your own due diligence and consult a financial advisor prior to make any trading decisions. And Rightline Trading is not a registered financial advisor and not a licensed commodity trading advisor. So with that said, just a little bit about myself. I'm a graduate of the University of Pennsylvania, former professor at Jefferson University in Philadelphia. I have about 20 published articles to my name in top-tier journals, and you can Google them. If you put parentheses, Sachs, MK, they're still there, or at least a lot of them are. I began trading the futures forex markets about 10 years ago, and the mandate here at Rightline is for us to do mathematical modeling. And what we look upon is we look upon any given financial instrument as a closed system. And every closed system is defined by a series of independent variables. And those independent variables determine the future direction of price. And when those independent variables are then placed in a multivariable equation and optimized, they can, with tremendous precision, determine the direction of a given market. Now, it doesn't make any difference what the instrument is, whether it's a stock, whether it's a future, whether it's a forex pair, and these forces are independent of time. You could trade a 3-minute, 6-minute, 9-minute. You can trade a 4-hour bar or a daily bar. You can trade tick, and my favorite is to trade range, 8 range, 13 range, 21, 55 range. It does not matter. If the independent variables work, they should work across every financial instrument, and they should work on any time frame. And actually, right now, we're using them on the cryptocurrencies, and we're up 100% on Litecoin. But that's a topic for a different discussion. Now, there's a problem with current technical analysis, and that is it causes 95% of day traders to fail. And that's because they're using the same indicator analysis and the same underlying trading methodology that traders have been using for the past 20 years. And the problem with day trading and swing trading is that each generation of day trader fails to learn from the previous generation. Now, I don't believe that fibs work, and we've tested them on 2 years of market replay data. There's no reason to assume they should work. They were developed by an 11th century mathematician 900 years before the advent of the financial markets. Although there's some Fibonacci symmetry in nature, there's absolutely no reason to assume that they're going to predict the future direction of price in a given financial instrument. And yet Fibonacci continues to have a lot of appeal to traders, yet it's never been proven to work, and I can tell you it doesn't. So what we have to do is not accept any current dogma without mathematical verification. We can't accept the fact that an oscillator crossover, oscillator divergence, MACD divergence, any of these signals are going to work because they haven't made money for traders in 20 years. And if you do a Nexus Lexus search of the world literature, you're going to find that there's very little authoritative scientific work done on day trading or swing trading. No one has looked at the sensitivity, specificity, or positive predictive value of a trading entry based on this type of analysis. And I can tell you it's been around forever, and it's caused 95% of day traders to walk off the financial cliff. So what we've done at Rightline is we've taken a completely different approach and analysis, and we've really discarded all of this. Now, what we've determined to be the independent variables or the independent forces that come to bear on a given financial instrument is, one is the multi-time frame analysis of trend. You're going to see how we do it. And this is the time to trade. When your time frame and the two higher time frames, they all correlate. But I have to show you what that means. And what I'm showing you today is our algorithmic trader, and I want to show you how it does a multi-time frame analysis and looks for all three time frames to lock. Also, we do a multi-time frame analysis of correlative markets, which is an analysis of money flow. We do a multi-time frame analysis of order flow, which is exceedingly important. It tells you who's in control of the market, buyers or sellers. We also do a multi-time frame analysis of momentum, and we leverage market profile very, very strongly. Now, the dependent variables that are moved by these independent variables are oscillators, MACDs, Fibonacci, classic Elliott wave. If any of these are used to get you a trading entry, what they're going to do is they're going to prevent you from taking winners, and they're going to walk you into losers. Bottom line is that they are going to degrade the precision of your trading. Now, two really important independent variables or independent forces that predict the future movement of price is the multi-time frame analysis of momentum, which is done in this upper line, and the multi-time frame analysis of order flow, and this is order flow tracking, which is done automatically by the algorithmic system. And I just want to explain to you how it works. Just excuse me for 1 sec. I just had to take some water. Now, there's a lot of ways to analyze momentum in the upper line. The oscillator is a momentum indicator. MACD is a momentum indicator. But what we look at is we look at Heikin-Ashi momentum. We've stripped the bars off the Heikin-Ashi formula. We've modified the formula. And that's what we use to analyze momentum. It's a very, very precise momentum analysis. But what we do, and what's really critical, is we ignore price on your trading chart and only look at the two higher time frames. So if you're trading a 3-minute, it looks at the 9-minute and the 27-minute. 3 times higher is 9. 3 times higher than 9 is 27. Now, there is Fibonacci symmetry, although it doesn't predict the future movement of price. So if you're trading a 5 range, it looks at an 8 range and a 13 range. If you're trading an 8, it looks at a 13 and a 21 range. And it's the same thing if you're trading a tick chart. It looks at the 2 higher fib numbers than the tick chart that you're trading. And if you're not trading a tick number, it defaults to the nearest fib number and moves to the 2 higher fib numbers. The key, though, is it doesn't use any data from your trading chart to create its analysis. That is what makes it a truly independent variable. So when momentum is aligned to the downside on your 2 higher time frames, and order flow is aligned to your downside on your 2 higher time frames, price is almost always going to fall on your trading chart. Now let me tell you how we calculate order flow. I'm going to go into it again later, but I'm sure most of you are aware that each candle has a delta, and the delta tells you whether there's an abundance of buyers or an abundance of sellers at each tick level or each cent level or each pip level on the dome. And then if you add up all the buyers and sellers on each side, on the bid-ask side, you get a delta. The delta tells you if it's positive, there are more buyers. If it's negative, there are more sellers. And what we do is we put that delta, into a 15-period moving average, and we create a delta moving average. When the delta moving average is down on the 2 higher time frames, this line is going to be orange or red. I'm not going to go into the difference between orange or red because we've eliminated the orange since I made this slide. It's going to be either red or it's going to be green. Red, an alignment of both higher time frames to the downside. Green, an alignment of both higher time frames to the upside. You cannot trade in the opposite direction to order flow and momentum when they're aligned like this. And this is what the algorithmic system is looking for. It's looking for a direction to trade. It wants to censor a given direction. And this is telling the algorithmic system it can only trade short. It cannot trade long. Now here's what happens when order flow and momentum align. The only thing the algorithmic system will do, and the only thing that you should do, is you're going to trade long. Now you have to look for an entry. We're not talking about the entry here. We're only talking about a directional bias. And you see that all the traders in these counter trend candles, these orange candles that are counter trend trading against the direction of Heikin-Ashi momentum on your 2 higher time frames and order flow analysis on your 2 higher time frames are going to get run over. What they're doing is they're trading oscillator divergence, MACD divergence, they're trading off of Fibonacci resistance. Whatever they're doing, it's failing, and it will always fail. And here's another example. Now, the time frame is unimportant, and the instrument is unimportant, which is why I didn't put them up here. It doesn't matter what you're trading. This could be Netflix. It could be gold on a futures market. It could be the euro-yen. Doesn't make any difference. When order flow and momentum are aligned to the upside, it's going to put significant buying pressure on the financial instrument you're trading on your trading chart. If you ever want a counter trend trade, and I don't recommend that you ever do, at least you have to wait for order flow and momentum to turn. At the very least. Now, this is what the algorithmic system is looking at. Now, this is also what you should be looking at, because this is what the algorithmic system is looking at. What happens when two forces that determine how price is going to move out into the future don't align? And remember, they don't always align. In this case, momentum is aligned to the downside, and order flow is aligned to the upside. And if you ever wondered what creates chop, this is exactly what does. It's when those independent forces that come to bear on price don't align. So price doesn't have any idea, excuse me, I don't know why I'm getting these signals, doesn't have any idea in which direction to move, because these are equal in force. They exert the same amount of pressure on price here. So what price does is it just chops. So when these are not in alignment, the algorithmic system stands down and will not trade. Now, a lot of algorithmic systems are black box systems. What I'm showing you are all the independent variables that go into the algorithmic, so you understand exactly when it's going to take a trade. And we go over all the trades at the end of every trading day anyway. But I want you to know and understand exactly what the algorithmic is looking for. And you can see, once order flow and momentum align and stay aligned, price on your trading chart is almost always going to fall. And any one of these counter trend candles, the green candles, or this B is a counter trend run over by a C, they're all going to get run over. And remember, these traders in these counter trend traders are those 95%. Those are the traders that will forever go bankrupt, because they're trading systems that don't work. I just wanted to show again, because I think it's really important to know that when these independent predictors of price movement don't align, price chops. But as soon as they do align and price breaks above resistance, you get a nice long trade. And that's what the algorithmic is sitting, waiting, and hunting for. Now, the multi-time frame analysis of trend, there is an equation in math that tells you that all independent variables are not equal. At any given time, one independent variable can hold sway over another, and it's called the nonlinear relationship of independent variables. And it's what provides you, unfortunately, with that little bit of discretion that you sometimes have to employ when you swing trade or day trade. Now, the algorithmic system has no discretion, and every single independent variable must be locked in and in the appropriate direction in order for it to trade. But the most important, I think, and the most powerful is that multi-time frame alignment of trend. Now, almost every other background bias indicator you see on other software packages only tell you what you already know. It'll go pink or red when price falls on your trading chart. So who cares? It's already telling you what you can already see. What this pink represents is that this is a 5 range. So it's analyzing price movement on the 8 range and price movement on the 13 range. Your 2 higher fib numbers. And what it's telling you is that the 50, and let me find a chart where I have the 50. Here's our 50. It's down. Our modified 15 is down in red. And the 15's crossed the 50 to the downside, and price is below the 50 and the 15 on your 2 higher time frames. So The 50 is down, sloping down in red. The 15 is sloping down in red. The 15's crossed the 50 to the downside, and price is below both moving averages, which means all support is broken. And this is occurring on your 2 higher time frames. Again, we always split indicator analysis off from our trading chart because we want those 2 higher time frames to predict where price on our trading chart is going to go, and it does so with amazing accuracy. So when background bias turns pink, now you can do this on your own by looking at those 2 higher time frames, but the algorithmic system trades 8 markets at the same time, and soon it's going to be trading 13 at the same time. So try to look at 39 charts at the same time to do the same job. And you can see when your 2 higher time frames, when price is broken support, and the 15 and the 50 are red, and the 15's cross the 50 to the downside, price is almost always going to drop on your trading chart. It's another independent predictor of price direction, and it's an additional way of the algorithmic system assessing the appropriate direction to trade. And when there's no multi-time frame alignment and trend, that is when price chops. So you have to be very careful to trade during this period of time. And it's amazing. I mean, part of what you're going to get is trading with me every morning. This morning we had 3 trades and 3 winners. Is if you try to take a trade when that multi-time frame alignment is not there, how difficult it is and how much easier it is when you get this aligned. And this is the same thing to the upside. Now, this is the E-mini. The size of this move is irrelevant. What this is simply telling you is the 50 is sloping up, the 15 sloping up, the 15's crossed the 50 to the upside, price is above the 15 and the 50 on the 2 higher time frames, so all resistance is broken, and price is almost always going to rise on your trading chart. What you're looking for here is a low risk, potentially very high reward trade. That's what the algorithmic system is trying to enter. Now, here is another independent variable. This is the way that we track money flow. Now, a lot of systems say they can, but it is not easy to do. Now, remember, order flow tracking is an indirect way of tracking money flow. When there's an overabundance of buyers on the dome, you have to assume that more money is flowing to the buy side. And when there's an overabundance of sellers, you have to assume more money is flowing to the sell side. But I think this is a more precise way of tracking money flow and a better way of giving the algorithmic an additional independent variable to hang its hat on to determine the appropriate direction to trade and make sure that all of these independent forces align. Now, we all know that usually 70% of the time, and we're looking for a correlation coefficient of 0.7 or greater. So 70% of the time when the E-mini falls, the NASDAQ falls, the S&P falls, and the Russell falls. And 70% of the time or greater when those 4 markets fall, Treasury bonds and Treasury notes go up. And the reason is really very simple. What the institutional traders do in the course of a given day, the amount of money in all of the financial markets combined is pretty much fixed. And what determines where things move is that the institutional traders rotate their money from asset class to asset class based on their perception of risk. Now, when risk is off and they don't want to invest their money in stocks, the NASDAQ, the E-mini, the Russell, and the Dow are going to fall. And now, not every time, but 70% of the time or greater. And 70% of the time or greater, they're going to rotate their money into more safer investments like treasury bonds, treasury notes, certain currencies, and certain precious metals. We call them quant lines because each of these markets is quantitatively weighted in these lines by virtue of its correlation coefficient. We use those to look at money flow or this asset class rotation. Now, this is a chart of bonds. Now, we don't let the algorithmic trade bonds anymore. And the reason is that every 90 days, we do a reassessment of every single market because we found that about every 90 days, there may be a change in the way the markets move. Maybe and it's really the metric that changes is their volatility. Now, bonds and notes were a great instrument for the algorithmic to trade for a long time, and then we saw their performance degrade, so we booted them out. And this is a slide I took for when it was trading it, but the point it makes is still extremely relevant. When the lines are green, it means that money is flowing into bonds. Green, money is flowing into bonds. And the algorithmic knows to only take a long trade. So now you have order flow, momentum, the multi-time frame alignment of trend, and money flow. Now, what these lines are looking at are all the markets that rise when bonds are rising also rise, and the markets that should fall when bonds rise are falling. It shows a true rotation in money from one asset class to the other and tells you that bonds is going to rise. And again, this is what happens every time a true independent variable doesn't align, the market chops. When these lines are yellow, the market breaks down and it becomes very difficult to trade. This is when you, as well as the algorithmic trader, should never try to enter a trade. Because if you're a day trader or swing trader, you should be so allergic to risk that you don't want to assume any risk on any trade that you don't have to. And this is how we've programmed the algorithmic. It doesn't want to assume any risk. Now, you saw this chart before. It's right here. It's very common when there's a multi-time frame alignment and trend to also see an alignment in money flow. Now, there's 2 quant lines on bonds, but there's 3 or 9 correlative markets on the E-mini. Stocks have 3 correlative markets. All the index equities, the Dow, the NASDAQ, and the Russell have 3 lines or 9. But this shows you the direction to trade is long because money is flowing into this financial instrument. And oftentimes it's associated with a multi-time frame alignment and trend. It's associated with momentum aligned to the upside, and it's associated with order flow aligned to the upside, giving you a clear-cut directional bias and almost guaranteeing you're going to run over every counter trend trader in this move. Now, market profile is extremely important because it's the way to leverage volume when you trade. Now, in a perfect world, the random distribution of any set of data creates this perfect bell-shaped curve. And we don't live in a perfect world, but this is what this is why market profile is so powerful, because it's based on this fundamental math. And this mean price, which is right at the tip of the bell, which is also the median price and mode price, which is the price at which most volume has crossed. If you take a swing around it, or one standard deviation's worth of volume at price, creates what's called the fair value area, or the fair value for that trading instrument. That's what traders have decided they want the price of this instrument to be 66 2/3% of the time. Now here's our market profile. Now since this time, this is market profile, this is our original, and now on market profile 3.0. Now I have some slides of market profile 3.0. It's much more sophisticated, but the basic principles that drive it are fundamental principles that never change. That fair market value for any given instrument, it doesn't matter what it is. It can be stocks, futures, or Forex. And this is how I trade options, actually. And I have an options newsletter that is up almost 100% this year. When price approaches the value area high, it gets pushed down. When price approaches the value area low, it gets pushed up. And the point of control is the price that traders favor the most. It's the price that most volume has crossed in the given period of time that this volume profile is doing a look back on. Ours looks back a proprietary number of days, requires more than a single day's worth of volume in order to create a really powerful analysis. In addition, what's really important is this market profile changes intra-candle. If you're trading a 9-minute, or some traders trade a 4-hour or a daily, you can't wait 1 day for this market profile to change. You've got to know where it is from tick to tick, from cent to cent, or from pip to pip. Now there's also critical low volume nodes, and those are just the opposite of the point of control. Those are where nobody wants price to trade. It's a price rejection. So here on the E-mini, 2346 and 2340.25 almost have no volume. So what it does is it creates zones of rejection. Now when price moves up into this zone, it's a powerful area of resistance, and the algorithmic system won't trade into it, just like you shouldn't trade into it. You don't want to accrue risk. And it creates a powerful zone of support as you trade down into it. You've got a price that's been rejected, and another independent force is price wants to stay within fair market value. So here's what happens, and I see this all the time. Price hits, comes back and hits, and then off of the value area high, or the zone of rejection, it just crashes. It happened today on crude oil. It happened today on the 6E in the live trading room. When price collapses, it's usually off the value area high. Or if it skyrockets, it's usually off the value area low. That's why you can't trade short here or long here. And then you finally get a break of support. When you come back up into resistance, you're going to take a short trade. Now we're just using this as an example. We don't know the alignment of trend. We don't know money flow. We do not know order flow. We do not know momentum. All I want you to be aware of is that the algorithm will not trade up into a zone that's acting as resistance or down into a zone that's acting as support. Just like you shouldn't do that either. Now here's an example of just combining market profile with order flow. Once this area of support is broken and order flows aligned to the downside, the only direction the algorithmic should trade, or you should trade, the only direction the algorithmic will trade and the only direction you should trade is short. If you try to counter trend trade, order flow, you'll get stopped out. Now, when you're sitting at the support of the point of control, you can use the support area to go long if order flow is aligned to the upside. If it is, you can take a long trade. When you come down and move up to resistance, if order flow is aligned to the downside, you can go short. And then you're going to sit here and not trade long until order flow aligns to the upside. If you do, you have a high probability of getting run over. Now, this is our market profile 3.0. And this also looks at the point of control, which in a given candle is called the COT, or commitment of traders. And I know I'm throwing a lot at you, and a lot of webinars are 85% advertisement, and they don't really show you the system until the very end. And it's sort of like what you get to see for the last 3 minutes, where what I'm doing is I'm really drilling down into all the variables that the algorithmic system needs in order to trade. But these are also all the variables that you need when you trade. Now, this yellow tick level is called the COT, and it really is the point of control of a candle. It's the tick level or pip level or cent level on a stock where the most volume has crossed at price. It's exactly like the point of control of a chart, only to discriminate it from the POC of a chart, which is this magenta line, it's called the COT. On a long trade, when the COT is in the lower 1/3 of the candle, you get a great long trade. It increases the positive predictive power of a long trade. When on a short trade, when the COT is at the top of the candle, and this is the essence of order flow tracking. And this is really down to bare bones. Now, a lot of systems show you the intra-tick or intra-pip or intra-cent buy-sell level. That data is not useful. What's useful is the delta that's created to allow you to create a delta moving average and look at order flow. And what's useful here is the COT within a given candle, and to look at the point of control or the commitment of traders. On a short trade, you want to get the upper 1/3 or at the base of the candle body. And you can see this candle body is right here. And if you have any trouble seeing the candle body, to the left, this hash mark here outlines the candle body, and you get a great short trade. The algorithmic system is looking for that. It's looking for the COT to be in the upper 1/3 or at the base of the candle body for a short, the lower 1/3 or the base of the candle body for a long. Another independent predictor of price movement and an essential component of a successful long trade or a successful short trade. And here's another example. Here's a pullback to support. Now, I label this as the POC, but it's wrong. It's not the point of control. It's the value area low. Point of control is up here. Now, we also do an analysis called the VWAP, which is the volume weighted average price. And it is a strong area of support and resistance. If the algorithmic system will trade up into it if the point of control of the candle is at the base of the candle body, which is exactly where it is here. And it predicts for the algo system that the area of resistance is likely to break. It does, and it carries the trade all the way to the top. So it thinks when it approaches an area of resistance to the upside or support to the downside. what's the commitment of traders doing in this move? If the commitment of traders remains firmly committed to a long trade, it's going to allow you to hang in that trade to milk the trade, just like you should do if you're trading on a discretionary basis. It allows you to make an assessment of whether or not support or resistance is going to be broken on a chart. It's not always right, but it really is extremely accurate. I'm just going to skip that. Now, this is the final independent variable, and it's not done on any other algorithmic system. We use it in the trading room to trade on a discretionary basis. It's the most complex indicator system that we have, and it's not 21 indices anymore. We booted out 5. It's now 16 indices that are grouped into the Dow, the NASDAQ, the S&P 500, and the Russell. And of these 16 metrics, 8 are volume related and 8 are tick related. And I'll show you how it works. Now these are the instruments placed into the instrument manager. And there's the semiconductor index. Here's the S&P 500. It's analyzing all this data. And essentially what it's doing is something that no one has ever done before. Isn't it better to take a long trade on the NASDAQ futures market when the internals on the NASDAQ cash market are aligned to the upside? And isn't it best to take a short trade, say on the E-mini futures, when the S&P 500 internal cash market is aligned to the downside? This is the first time I've ever seen the application of the cash market internals to help you predict the direction of trading on a futures market. And it's a real sophisticated indicator. It looks at the ratio of up-down volume, the ratio of advancing issues over declining issues. It looks at the ratio of upticking stocks to downticking stocks, the ratio of advancers to decliners in specific ETFs and specific indexes like the SOX, the semiconductors. It really does a really intricate analysis of the internals, what's going on inside the cash markets, to help you get a trade on the futures markets. And when they align, it's amazing how well your markets fly. Now, it's 2 lines, and you can see this says RL Quant Cash E-mini. This is a 3-minute. The upper line is all the tick data. The lower line is all the volume data, and for some reason, the tick data is faster. This changes color quicker, and it'll catch a change of direction quicker. The volume data, for some reason, is slower, and I have no idea why that is. It just happens to be that way, though. Now, we're only talking about the algorithmic system, but this gives you the ability to trade, to trend trade, to trade gaps and market open and reversals. It really gives you a lot of power. But what we're only going to look at right now is, now I'm going to show, even though the algorithmic system does not trade stocks, I'll show you a few stock trades. This is the cash applied in the cash markets. But when you have that multi-time frame alignment and trend, you can only go long. Right in here, all the cash internals are aligned to the upside. Here's order flow and momentum. I haven't gone over a specific entry yet, but we will very shortly. And you get a great long trade. The risk to reward on these trades is unbelievable. This is a 40-cent risk. You can make 40 cents on a risk at 10 cents. Now, I'm not going to really go over many more stocks, because it's not what the algorithmic system does. But you can catch great trade after great trade when all these things align. This is Tesla. This is Netflix for a gigantic move down. Here's Akamai. This is a 60-minute of Akamai. This is a $1.05 move on a stock. I can't remember how much it is. This is about a 10% move. And here's Garmin. Here's NVIDIA. Huge move down. Here's Best Buy. Here's Optokinetics, which I really liked. I've traded many times using options. Here's Console Energy. Here's Facebook. Now, here's the NQ. Now, if you want, this is a 3-minute of the NQ. If you want to trade the NQ futures short, the best time to trade it is when the cash internals are aligned to the downside. And that's what the algorithmic system looks for. It's only going to give you a short trade when you have the multi-time frame alignment and trend, order flow and momentum are aligned to the downside, cash or money flow is out of the NQ, and the cash internals are aligned to the downside for a very low risk, in this particular case, nice high reward trade. This is the E-mini, same thing. Cash internals on the S&P 500 are aligned to the upside. Now, there are multiple long signals here, but you have to trade in the direction of the cash internals, or you're trying to take the E-mini futures long when the S&P 500 cash market is going short, and you're almost always going to get run over. And it's a factor that's almost never, ever looked at when traders try to trade futures. Now, obviously, there's no cash market on crude, and there's no cash market on gold. But there are cash markets on the E-mini, the Dow, the NASDAQ, and the Russell. Now, this is just a market open. This is not an algorithmic trade, but when they're aligned to the upside, this is a 7.25 point move right at the open. Now, these are the individual entry signals that the algorithmic looks for and that we look for in the trading room. Now, this is called a strategy entry. Now, it does a multi-time frame analysis like all of our indicators. If an indicator just analyzes oscillators and MACDs on your trading chart, or it looks at price just on your trading chart, it doesn't tell you where price is going to go. It tells you where price has been. This looks at price action, market structure on your 2 higher time frames. And if you open up the back end and you look at the inputs on this, they're complex because it's doing a multi-time frame analysis. And you can see the 15's down, the 50's down, and you get a great short trade. Now, the algorithmic system is only going to take this signal if order flow and momentum are aligned to the downside, if money is flowing out of crude, and market profile aligns, and every other independent variable that can possibly predict the future direction of price are telling us and confirm that crude is going to take a long trade. But that's the signal it looks for to enter on this candle 1 tick below the close. Now, the signal occurs right at the start of the candle, and the entry is fired into your computer, into your Superdome, and it's there. Now, if the candle doesn't mature down to close at the appropriate price, the auto trader cancels the trade. It either gets the price it demands, or as the trade matures, the auto trader will pull the trade out. Here's a long trade, and here's a short trade. Now, the ABC entry, it also looks for. These are very powerful entries as well. This is the only entry we have that only does a single time frame analysis. because it's really a pure price action entry. And what we're looking at here, this ABC pattern is drawn by the software. I didn't draw it onto this chart. And any two candles in a row of the same color, based on price action dogma, create a trend. And an A will appear at the close of the candle to complete the first two down candles. Then it looks for a counter trend trade. It looks for a long candle to close. Now I have elected to color that counter trend candle magenta, because when I'm trading in the trading room, I always want to see those Bs. I also get an audible alert. Now the algorithmic is looking for the C, which has to engulf the B. It's going to set up the trade and give you the entry one tick below the close. If the trade matures, it has a great probability of running for two reasons. One, it's trading in the direction of the trend and in the direction of money flow. So additional money is going to come into this trade to the short side. The institutions are going to continue to buy contracts short. In addition, all the long traders in this counter trend candle are going to get stopped out as the trade moves down. And they're all going to have different pain levels, and they're all going to let go at different points. But as the trade matures to the downside, it's going to get pushed down even further as everyone in this counter trend B gets stopped out. That's why you never want to be caught counter trend trading, and you ask yourself, why the heck are these traders going long? The 50's down, the 15 is down. For all we know, this is a multi-time frame lock to the downside. Order flow and momentum are down. Why are they buying the market long? I'll tell you why. Oscillator divergence, MACD divergence, whatever it is telling them it's time to go long, and they're just absolutely going to get run over. And the algo system is going to run them over. Now, and here's another ABC pattern. Here's another ABC pattern, 35 ticks, 36 ticks. The size of the move is unimportant. What's important is that the entry is associated with extremely low risk and the potential for significantly high reward. That's all you can do on a trading entry. If this made 9 ticks and it was associated with a very low amount of risk and potential high reward, it's a very successful trade. Now the consolidation entry is the last system-generated entry that the algorithmic system looks for. Now you can see these blue and red channels, and you can see them here, you can see them here, you can see them here. Here, here, they're all over the place. Now the system is always looking for price to consolidate. Now, during a consolidation period, what happens is the power of the bulls equals the power of the bears. There's an up candle, a doji, a down candle, an up candle, a down candle, but consolidation almost always breaks in the direction of the trend. Because remember, the trend is the direction. It's created by the institutional players, and if this is a multi-time frame aligned trend, you're almost guaranteed a break to the upside. Except most systems are going to get you in on this candle, the candle that actually breaks consolidation. Our system gets you in a candle early on this triangle because of its multi-time frame analysis. The higher time frames will signal the break of consolidation on your trading chart before it occurs. And this is a very precise entry. Now, if the algo would have taken the first triangle or first consolidation entry, and it would have taken a little bit of heat, because the software generated a second entry here, but it caught this whole move up out of consolidation. And you can see out of this area consolidation, no signal. this area consolidation, no signal, no signal, because the consolidation signal is a smart signal. It has to, it looks at the 15, it looks at the 50, it looks at the distance that the candle is off of support before it's going to fire. Here's another entry. Two more out of consolidation I really like because it's more powerful than a C candle, because a C candle runs over one counter trend candle. Consolidation can run and must run over two, because that defines a consolidation channel among many other parameters. It catches lots of traders in the counter trend direction, so it really gets pushed up really hard when these traders get stopped out. The longer the channel, the more power it breaks with. I mean, this again is a break consolidation on a stock. This is Wynn Resorts. Here's crude, and here's your break and short trade. 44 ticks and 19 ticks. These are algo trades. I'll just look at the really clear ones. Here's a trade off the point of control for 3 3/4. I only have part of the algo system showing, and you can see there's a short algo trade. I mean, these are very big trades. Here's 34 ticks on crude for 360. I'm just going to move through these. Now, it also works on Forex. And you can see this is a $655 trade, 43 pips. Trading in the direction of money flow, order flow, momentum, with the multi-time frame alignment of trend, with the strategy signal as the entry. Now, the algorithmic is not optimized for Forex yet. We'll talk about what markets it is optimized on. Here's the pound dollar, and up it goes, 52 pips, 610. And I'm going to bypass here all the stocks. So let me just go, I have two testimonials for you because I'm closing in on the hour and I want to answer any questions that you have. A lot of people throw up these testimonials and they're all a bunch of baloney, but these are two real testimonials. Jersey Tony and the next testimonial I'm going to show you are both top step traders, and therefore their performance is public. And he just talks about we have world-class accuracy, and we have appropriate rules and discipline, and that he's been with us for 2.5 years. And he writes, I'm confident that will help others who aspire to become consistently profitable traders. And D. Moore, he won the 2016 Top Step Trader Games. That's him, DMOER, $54,047 in the $50,000 combine. It's a lot of money on a $50,000 and this $50,000 combine. And he writes, the trend is your friend. RLT software leans on that heavily. The ABC system generated entry that I look for, and the creation of the C, blah, blah, blah. I don't want to read it all. It helped me win the 2016 Summer Games with Top Step, first place, $50,000 combine. He got 21 straight days without taking a loss when he started trading cash. That's how well he did. Now, he isn't trading the algorithmic, but he is trading the signals that the algorithmic takes on a discretionary basis. So let me just show you. I can't click on that. I'm going to move out of here for 1 second, and I'm going to go to the actual results of the algorithmic system. And there. Just move to here. We're building a new website. We're going to have that up pretty shortly, and it's not going. And we're going to be sending out the results. Well, actually, we're going to be posting them in a user friendly. You have to have a username and password, but this is our old website. You just go to Products Futures, Algorithmic Trading System Futures. Go to Learn More. and then you go to algorithmic performance. Now here's the system's performance. And let's go down to the bottom here. Now it should be up to date. I don't know why it's not. Hold on a second here. I don't know if I'm doing something wrong. Because I know Sergio posted this through. Let me see if I can just refresh. It may not be, maybe just the cookies here. Hold on. I just did. Now, I don't know why. I'm just getting through 1129. We're posted through 1211, and then we're at $37,000. Now we're at $33,000 through 1129. Yesterday, the algo made $555. Today, it made $75.25. So in the last 2 trading days, it's up about $600. And I don't know why this has not been posted. It should be up to date. But the equity curve has continued to rise. Now, this is the profit on an initial account of $5,000, not taking into account that $5,000 investment. If we put that 5 in there, that would be 38,466.13. This is starting the profit at 0. I don't think you want to bother with that. So let me just put the slides back. Unfortunately, every time I do this, I have to scale them down quickly. Now, we post the results every day, and I don't know why I can't pull them up on the website. Now, here's what we're offering you for the webinar. Here's our phone number at the top. I'll show it again. Now, the automated system is normally $3,900, $3,999. It trades gold, crude, the E-mini, the NASDAQ, and it really slams the currencies. It trades the 6E, the 6B, the 6C, and the 6J. It does really, really well with the currencies. Yesterday, it had 3 winners on the 6E. It really does well. Now, the NDT Trade Execution Platform is our own platform, and you need that in order for the algorithmic system to signal an entry. You get to come into the trading room with me for 3 months, and you're really going to learn our system. And also, we have a lot of traders in trading school. We just had a session yesterday where we talked about the math of day trading and trading methodology. And it really allows you to understand how to trade with precision based on mathematics, not just on something somebody taught you, but you're in that 10-week course because you're in the room for 12 weeks. You'd be coming in on module 6, but then it's going to come back around and you're going to get modules 1, 2, 3, 4, and 5. Plus you'll have those first 5 available to you on a link if you want to listen to them. Then you get access to our video tutorial library, which has 450 videos. It's $18.99 in one payment, or it's $9.99, 2 payments a month apart. Now, we're within the next week to 10 days, we're going to be adding the agriculturals, soybeans, corn, and wheat, silver, and copper. Now, those are going to be add-on markets, and we're going to charge by the market. And the first 5 will get these add-on markets in the week or so that it takes us to add on. They've already been optimized, and they trade great. Copper is a superlative additional market, especially. Silver, too, gives great entries. Soybeans and wheat and corn chime in. It only trades them when there's good volume, I didn't really go into how the automatic trade management strategy is modified because there wasn't enough time. But those 5 markets will be added on, and they will be active very, very shortly. They're all optimized already. Just a matter of putting them into the system and getting them out. And the offer expires this Sunday night. So this is the order's open, and the first 5 get the 5 additional markets. So let me just see if there are any questions. Okay, guys. Hey. Okay. Well. Okay. No. Okay. No questions. But these are all early. If anybody have any other questions? Okay. All right. Well, listen, guys. Have a really, really wonderful day. I hope to see you aboard. Rory, did you put a purchase link in the room? Rory? Okay, the link's in, and we'll be sending you an email with a copy of the a copy of the video. So listen, everyone, have a really, really great afternoon, and I wish you all the best of luck in your trading. Take care. Have a great afternoon, and we're here if you have any questions or you want to call us. Our number is 786-713-5276. 786-713-5276. We're at rightlinetrading.com. Emails info@rightlinetrading.com. Everyone have a really, really great evening. Thanks a lot, Stephen. I really appreciate it. Take care. Have a good evening. Bye-bye all.